Welcome back, everyone, and thank you for joining us, sticking around for session 2. I hope you learned a lot in the first session, did some Greek overview, and then I would say a pretty deep dive into delta and gamma, and that might be the most complex session of the day. We're going to do some Vega, Theta, and Rho discussion here, which will take care of the rest of the first order Greeks, and then we'll try to implement these and talk about some other things in our third session. My name is Ed Modla, the Director of Retail Education at the Options Industry Council. I've been in this role for about 5 years. Prior to that, I was in the brokerage and the trading industry, and this is what we do, teach investors about the benefits and risks of listed options. I'll start our presentation out today talking about Greeks and Theta. And here is our disclaimer. Options are complex investment tools that need to be understood thoroughly before implementing them in a live trading account. And our outline, pretty simple, a few words on Greeks overall, and then we'll get into Theta and some examples and quizzes along the way. Try and keep things interesting and test your knowledge on what you've grasped on the material as far as Theta is concerned. Same thing with Vega. You can't talk about Vega without also discussing implied volatility, historic volatility. So we'll get into that as well. Jamal will be coming up to discuss Vega and volatility with you. And then I'll come back on the end and walk through Rho, probably the least talked about Greek. It's very important, as I'll state later, it's very important with respect to pricing models, but it's less important with respect to risk in your position. It's not often that investors consider themselves in a position where they have interest rate risk. Q&A will be at the end of the session. For those of you online, thanks for joining us. The OCC Investor Services team is online behind the scenes answering your questions. Mark Benzaquin and his team are ready to answer. Just send your questions in through the Q&A box, and they will be answering online. In person, if you're stuck, if you're having trouble understanding a specific concept, you have a quick question, feel free to raise your hand. Otherwise, we'd like to get through it, and you can ask us questions to either me or Jamal after the session. We'll be up here for a few minutes to take your questions there. A few words about the Greeks overall. Let me say first order. What do we mean by first order? Well, there's a lot more Greeks than just these. There's dozens of them. And sometimes I'll be posed the question by risk management teams. They'll say, Ed, I've gotten this list of Greeks. Do you know what they are? And sometimes I don't know what they are. There's a lot of Greeks that exist that are derivatives of each other, and second tier and third tier Greeks. But these are the first order, the most commonly used Greeks that exist, and they are delta, gamma, theta, vega, rho. Earlier we discussed delta and gamma because they go together. Delta is the expected change in the option price as the stock moves, and gamma is the expected change in the delta itself as the stock price moves. And what we're trying to do here is formulate a way to forecast what happens to options prices as the variables in the marketplace change. And in addition to that, when changes do occur, we have a position that shows some profit or loss, we want to understand why those changes in prices occurred. And knowing what the Greeks are and how they affect prices helps us do that. The first theta for this presentation, or first Greek for this presentation, is theta, otherwise known as time decay. I'm also going to use the word time value as I walk through this, but I want to draw a distinction there. Time value and time decay are two different things. Time decay represents the natural erosion of an options price from one day to the next. Time value is different. It's how much value there is in between today and expiration date that accounts for the potential that the stock price moved. The first, theta. Simply put, it is the amount of expected erosion in the option premium amount given a one-day passage in time, expressed in decimal form on a per options contract basis, and that's a monetary amount. The number you see on your screen there is going to represent the actual premium amount that you would expect to see decreased as one day passes. This is natural. If there's one less day until expiration, that means there's one less day for news to hit the market or for the stock price to experience volatility. And that's really what option prices are all about, is expected potential for volatility. With one less day to experience that kind of volatility, then the theta will decay the option as that time passes. Both calls and puts have negative theta amounts. That means both of them erode with each passing day. Now, for those of you very familiar with this concept, I will also stipulate that we're talking ETF and equity options when I say this. It is possible that a European-style options contract has a different theta structure. We won't get into that here, but for equity and ETF options that are American-style exercise, meaning you can exercise early if it's in your best interest, calls and puts both have negative theta amounts. While we're on this topic, shifting gears a little bit when it comes to exercising early and talking American-style exercise, when it comes to call options, who knows what circumstance usually dictates early exercise? Someone said in the money, success. Someone said dividend. And dividend really is what it is. You think about what you do when you exercise an option early. If you exercise, you're buying shares. The intrinsic value of the option you can still capture by owning shares of stock and having that value versus where the stock's currently trading. If you exercise early, you give up time value. You give it away. If the dividend amount that's about to be paid is greater than the time value you give away, then that would be in your best interest to exercise early. I will add to that explanation and say that if there is time value, you could actually sell the option, capture the intrinsic and the time value, then go out and buy shares of stock and capture the dividend as well. So I would say it's not just that the dividend is greater than the time value, but actually when time value is 0 and you have an in-the-money option about to pay a dividend, that's when you might see early exercise on calls. What about puts? When would puts be exercised early? So put is, you're on the right track. The answer was maybe if it gets really, really cheap. So you're on the right track, but it's the opposite way. It's when the puts get really expensive and they're deep in the money. Think about what it means to own a put option. You own the right to sell shares of stock. If you have a put option that is deep in the money, 100 delta, very high value, you have this position that you could translate into cash. If you exercise the put option, you would receive cash and sell the shares. It might be worth your while to do that instead of holding a very valuable position that doesn't do anything for you. I'll get into a little bit of that later on when we talk about interest rates and cost of carry. But those are usually the two circumstances where you'll see early exercise: calls with dividends upcoming and puts with the cost of carry in an in-the-money situation. Time decay is on a per calendar day basis, not a trading day basis. Buyers of options are paying for movement. They want their deltas to work in their favor. And more specifically, the movement in the stock, the delta gain needs to offset the losses that they will incur with the passage of time. Now, it's not as easy as looking at this and say, well, they're per calendar day. So what if I just sold options on Friday afternoon? Wouldn't I have a pretty good chance and be ahead of the game a little bit come Monday morning? I have a good chance of being profitable. And of course, it's just not that easy for two reasons. One is there's a reason why it's calendar day. You are taking 3 days of risk selling options on a Friday afternoon. 3 days where things can happen in the world on a micro or macro level. Politically, economically, or something on Twitter can happen for 3 days. And you have that risk of the market moving. But in addition to that, and I speak from the professional side now, I can't speak to the extent this is done now, but when I was on the trading floor 20 years ago, and we were trading options, I was making markets, bids and offers on Friday afternoon. On slow days, if we started to see some order flow come into the pit that was selling options, I didn't want to buy them on Friday afternoon either. So all of a sudden, when I was running mathematical models to give me theoretical values on options, I started to take those days away. And a lot of times by Friday, a few hours before the closing bell, I was already looking at prices that were being calculated based on days to expiration that reflected Monday morning, because I didn't want to be looking at prices that were on Friday. You might see that occur with professional firms today as they take the weekend out, not wanting to be sitting there buying options on a Friday afternoon. You do have 3 days there, but also it makes sense. You don't want to load up buying options before the weekend comes and 3 days comes out. Let's look at an example. So now we know what theta is. It's the amount of expected decay on a per calendar day basis. And this is just simple arithmetic. And options trading at $3.50, and the theta is 3 cents. So 1 day passes, and it's very simple. All else equal, the option will lose 3 cents in value and be trading at $3.47. Now, say 10 days from now, it's just going to keep doing the math for you, but I want to point something out here. If we do this as we're looking at it mathematically, say, well, 10 days means you're going to have 30 cents come out of the option. That's $3.20. But now you're starting to have a little bit less certainty. As I said before, Greeks are numbers to forecast price movements in options with all else equal. Well, the theta is not going to be 3 cents for 10 days straight. None of the other forces are going to be the same either. So as you're going out further in time, you're going to be estimating values of a lot less certainty. It makes more sense to look closer, and as you go further out, you have to realize that maybe you have to change your perspective and know that there might be some inaccuracies with respect to what the theta is telling you. Now, I'll give another comment just to drive a point home here with respect to theta being inaccurate. There's a lot of reasons why investors and money managers use options contracts, but at the forefront of that is risk management. And that's buying puts to protect a long portfolio. Not buying puts because they're bearish, but to protect a long portfolio. Money managers are doing this all the time. It's a nice way to protect their investors against big market drops. It's also an effective use of capital. If they have the protection in place, then the capital requirements on their end are diminished. So buying put options and buying cheap put options is very popular and something that that investors and money managers are often doing. Even as expiration approaches, those small cheap put options, and I'm just going to say an example, like a put option trading for a dime tends to hold its value. Now you might see these cheap put options that are trading for a dime, that are worth a dime, that have a theta of a penny. But with each passing day, they're still a dime. They're not decreasing. Theta is inaccurate. It's wrong. And in the situation I just described, you will often find that to be the case. In those cheap, out-of-the-money put options that really don't lose their value very quickly, and they hold very small amounts of value, the theta you see is frequently going to be incorrect because theta is expecting the value to go down to 0. It's far out of the money. Who would want those options? Well, money managers want those options. So now take this a step further. If theta is telling you that the option should decrease in value, but it's not. It's staying where it is. There's less days to expiration. Remember, there's a mathematical formula involved in all of this, including stock price, strike price, days to expiration, and what Jamal is going to talk about soon, implied volatility. If days are passing, nothing's moving, but the option price is not eroding, the only way to make that math work is to raise implied volatility levels, even if the stock's not moving at all. And so you will see this happen frequently when you approach expiration. Volatility levels on the ends, really calls and puts, but most prominently in puts. Volatility levels increase just because those prices do not deteriorate as theta suggested that they would. Now, talking about strike prices and where is the theta difference between them, here's a graph, very, very popular looking graph that a lot of you may be familiar with. Identifying two different kinds of options. Here you have at the money and in the money. I'm going to talk a bit about the difference between the two of those. First of all, at the money. This is where most trading takes place. The decay is not linear. Long-term at the money options decay very slowly. They hold their value. I'm talking a year out, 9 months out, 6 months out. That turn in the curve where acceleration starts to increase, that's really hard to pinpoint exactly where that is, and it might be different from one stock to the next. I'm just going to say it's about 40 days out. Different firms, different instructors may say it's 38, it's 42, it's 44. Let's just say it's around 40 days where that acceleration of decay begins to occur, and the acceleration continues to occur through expiration day. Expiration day itself is going to have the fastest rate of decay. An option worth a dime that stays out of the money is going to be worth nothing at the closing bell. That's a 100% rate of decay. It doesn't get any faster than 100%. As an options trader, you're trying to find the sweet spot for you, and this is good to know. If you're buying options, you want to know where are you going to experience accelerated rates of decay, and where is the premium amount worth it for you to buy, and where does your risk tolerance find you on that scale. When you're selling options, you want to know this as well. Selling long-term options, you know there's going to be very little decay from one day to the next. Once you get around 6 weeks, it starts to accelerate. Now you might say, well, why not sell the closest options that are accelerating the fastest? And the simple answer is they have less premium to them. So you have to find that sweet spot for yourself as well. Even though you're getting very fast decay, for short-term options, is it worth it to sell an option that has very little value? I said an option worth a dime at the opening bell on expiration day is worth nothing. That's 100% decay, but is it worth it to sell an option for a dime? That's the question you have to ask yourself, and then decide what option you want to sell. Sometimes an investor will ask me when it comes to selling call options. Say you own shares of stock and you sell covered calls. I'll say, well, what expiration date should I use? Well, this is a good way to start that analysis, looking at the rate of decay. And investors often say, well, why wouldn't I just sell weekly options instead of monthly? I can sell 4 weeklies and capitalize more premium and get faster decay on 4 separate weeklies than I can get on 1 monthly option. And that by itself is true, but it really only works if the stock stays relatively constant or drifts a little bit higher. Remember, what you're giving up initially is the amount of premium you received. You sold a weekly option. It's got far less premium than the long-term does. So if there's a big move in either direction, the monthly would work out better than the weekly. But the premium that you're selling on the shorter-term option does indeed have faster decay. So given the right circumstances, weeklies might work out better. Given other circumstances, the monthly one might work out better. I suspect from one trade to the next, you might make a different decision on what expiration date you would want to use. In the money options, I'm not going to spend too much time here. In the money options have relatively little time value to begin with, and their decay is more linear in the money options, approaching parity as expiration approaches, and you have a smaller, more linear rate of decay. And this just highlights what the decay looks like from, on the left side, a 20% implied volatility level, on the right side, 40. That's the only difference between the two. I'm just going to look at the top versus the bottom. You see starting out with 1 year to go and then taking out over half of that time, about 200 plus days comes off, and the option lost $1.43. Now look at the bottom. Just going from 10 to 5 days, just 5 days, and you get 19 cents. So you had 215 days pass, and you lost $1.43. And down at the bottom, you just had 5 days pass, and 19 cents comes out of the option. That acceleration of decay as you approach expiration, at some point in there, in between that 30 to 50 days, is where that acceleration starts to increase. Then on the right side, it's just magnified. 40% volatility shows you bigger premium amounts, and it showcases a little bit more what theta decay is all about. Now let's test your knowledge, and let's go through a few questions and maybe apply this to a strategy or two so we understand what it means to have theta risk. Shares are trading at 100, and the investor is long the 95 put, short the 90 put, and that's a long put spread for $0.50. That's a $0.50 debit. Does theta help or hurt this position? Theta decay, the erosion of option premium. Does it help or hurt?
It doesn't affect it much.
It doesn't affect it much is one answer, and that could be relatively true, subjective, but it hurts. In general, it hurts the position. We paid for this put spread. It cost us 50 cents. So the erosion of the premium amounts is going to work against us. We own something that is 50 cents. We want those values to go up, not down. Theta decay is going to work against us. Another way to think about that is the 95 put is closer to at the money, and theta is going to be more magnified at the money versus the further out of the money 90 put. And how about this one? Comparing two different options to each other. Long and in the money 80 strike call for 20 1/4, or long the 85 strike put, out of the money put for 40 cents. Which one is more affected as each day passes and time erodes? Which option is more sensitive and has more theta risk? So I'm not trying to be too tricky here on this one. Remember, the passage of time, the erosion of an option premium is only going to affect the time value of an options contract. The intrinsic value is sensitive to stock price movements. Look at that 80 strike call. It's in the money by $20. Its intrinsic value is $20. That 20 is sensitive to the stock moving. It's not sensitive at all to the time decay. So the 25 cents part of the call option is sensitive to time decay from one day to the next. On the puts, it's out of the money. There's no intrinsic value. That entire 40 cents is subject to time decay. So the answer is the out of the money puts actually is more sensitive and has more theta risk. Again, to say in the same way as I did the first one, another way to look at it is which option is closer to at the money. Stock's trading 100, 85 is closer than 80. At the money is going to have more theta than out of the money options. Now let's look at a time spread. Short a 30-day 100 strike call and long a 90-day 100 strike call. Which leg will have a greater effect as far as what theta is concerned? So we're short a 30-day, long a 90-day. It's a time spread. Which one, the short or long term, is going to decay more rapidly?
30-day.
The 30-day, everyone got that right. So the shorter term, nearer term option decays more rapidly. So there's some good stuff on theta, some time decay, and where theta is in relationship to stock price movements and at the money and the options moneyness. And really this ties together well as we move forward with the Greek. So I'd like to bring up Jamal to come back up and talk to us about implied volatility, define that for us, define Vega, and then walk through some examples and strategies just as we did with the other Greeks. Jamal?
Thanks, Ed. Appreciate it. Okay, so we're going to talk a little bit about implied volatility in Vega. I happen to know a little bit about this subject, not necessarily just because of me, but because of where I work. So I work at Cboe Global Markets. One of the products that we have there is the volatility index, if you've heard of it, the VIX. And so that is a measure of implied volatility within the market. Implied volatility is essentially a way to gauge what's going on with the stock. So it's the stock's volatility in the past. Of course, you could have implied volatility for a whole market. You could have implied volatility for individual stocks, right? And so it can be observed and quantified. And this volatility is sort of a way to see what's moving, how the stock is moving, if you will. Quick example. How many of you have ever heard of StockX? StockX. And I don't mean a stock, I mean a company. You ever heard of StockX? That's exactly what I thought. I had never heard of it myself. I have a 16-year-old son. And one of the ways that we stay young is being connected to kids, right? So the reason why I bring StockX up because they do an interesting thing. So there's their website that's based on shoes. Trust me, I could care less about the company. I'm explaining this in the way that you'll help you understand implied volatility. What they do is they have a lot of sneakers on their website, okay? And they have this interesting way of showing you where the sneakers were last purchased, what prices. So let's just say like a Chuck Taylor, for example, whatever price that may be. You wouldn't expect a whole lot of volatility within a Chuck Taylor because there's not a whole lot of kids out there wearing Chuck Taylors, right? But something like a really, I don't know, some type of Jordan shoe or something that's really cool, there's a lot of volatility in those shoes because a lot of kids buy them for different prices. They may be a lot more interested in those. Another example is like, say right now somebody walks in here with a vintage Les Paul guitar. I don't play guitar, but I know about a Les Paul. And say just Ed and I are bidding on that guitar. We're both interested in it and we want to pay for it. You're going to see a couple of prices here and there. But say everybody in the room starts trying to buy this guitar and bidding on it. You're going to see a range of different prices. That kind of gives you an idea of implied volatility, all right? You're going to get an idea of what that guitar is worth based on everybody in the room having an idea of where they price it. In the beginning, somebody may know exactly the fact that that specific guitar was played by Eric Clapton or something like that, and on a certain song, and it has that much more meaning to it. And some of the people over here in this side of the room may not know that at all. And so they know they're comfortable in the price that they're paying for it. And they're starting to sort of pay more, and everybody over here is like, hey, what's going on? What's happening here with this guitar? Why is he buying more? Okay, well, then we're going to buy more. And so that's kind of how implied volatility will work. You'll see that in the stock. So specifically, you'll see implied volatility a lot of times when every stock has a normalized implied volatility, something that on the baseline what that implied volatility is trading for. When earnings are about to come out, you'll see implied volatility is higher, exactly, because we know an announcement is coming out. They're going to talk about what's been going on over the last quarter, right? And that announcement could make the stock move wildly. And so that's one of the ways that you'll see implied volatility. I think it's important to kind of understand it within that way because there's historical volatility that's based on the volatility of these stock price movements over the past however many period of time. And you can look at it in different periods. You can have a 5-day volatility, 10-day volatility, 30-day volatility. And that's what you should be using to judge certain options. If you're looking at an option that expires in 30 days, well, you shouldn't be looking at necessarily 5-day volatility. You should be looking at 30-day volatility. That gives you an idea of how it's moved over the past 30 days. So that's kind of the way you sort of examine volatility. So option implied volatility, it's a volatility assumption at which the option is currently priced in the market, right? So the market is pricing this option based on a certain volatility because of the way that traders are looking at it. It can be determined via option pricing model, which gets a little more complicated. You talk about the idea of Black-Scholes model, which is the option pricing model. Nobody expects you to understand or memorize that. I don't really even understand or memorize it. I know it exists. That's all you need to know. I say that based on the fact that, like I said, I used to be an engineer. There's a lot of engineering concepts that they throw at you a lot of times. You should understand the concept. If you want to get deeper into the weeds, it's always there for you to do. You don't necessarily need to know the Black-Scholes model to trade options, but you should understand that it exists. Volatility input, implied volatility is a volatility input resulting from the same value as the current market price. It reflects the underlying stock's volatility based or expected in the marketplace, okay? So it's the expected volatility that these options are going to move on. That's encompassing also what's going on with the stock. So it gives you kind of an idea of what's happening in the stock currently, what people are expecting, how it's expected to move. And like it says here, it's a consensus of all market participants. So everybody's looking at it, and you can get a pretty good idea and understanding of what's going on with that stock based on the implied volatility. Who ultimately determines that option market price? Well, like we just said, if we bring a guitar in here, everybody's helping determine what the price of that guitar is. On that website I was talking about, the shoe website, everybody's determining what the price of those shoes are going for because of what they're paying for them currently. Everybody's currently paying a certain amount for those shoes. And if it's deviating a lot, volatility is going to be high. If it's not deviating a whole lot, volatility is going to be relatively low. In general, when you're looking at volatility, a good way to think about it, implied volatility, is like kind of on a scale from 0 to 100. Now, it can certainly be higher than 100, and you'll see that often based on what's going, like specifically maybe in like biotech stocks. You'll see those stocks are typically high volatilities. Why is that? Well, a lot of biotech companies have drugs that will determine how their revenue stream is going to turn out. It could go all over the place. We've seen that more recently. There's been some stocks where something happened with a certain drug that was a large percentage of their revenue, and the stock got cut in half, or the stock went up 100%. That's what happens in those companies. And so volatility, implied volatility is typically high in those type of companies. As a general rule, and not always, but like banks, for example, they have a constant revenue stream. Their volatility is relatively low on a relative implied volatility scale. So you'll often see volatilities in the range of 0 to 100. Like I said, it can be higher, But you'll see that happen. Professionals and investors alike, we're all paying attention to these implied volatilities and what's going on. You got a question?
Yeah. Implied volatility, is that a value that comes out of some equation, like Black-Scholes model, or is it based on the...
It's from an equation. It's from an equation, but then it also, you'll see, it's anticipated, so it's expected. So the movement volatility usually is based off of historical vol, how that stock has moved historically. More recently, it could be like, in the last couple of days, the stock had a large move. The historical volatility is going forward, is going to be a little bit higher because of that large move. Now, all of a sudden, it's gone out of whack. But implied volatility is what's expected. So it's kind of an example of what's expected, how it's going to expected to move. Now, doesn't necessarily guarantee you anything. You'll see sometimes implied volatility may be high in a stock with a 30-day option, but then it was because the market was expecting some news within that stock, and maybe it didn't impact the stock as much as they thought it would, and then that volatility will kind of collapse, or what we say, or kind of come in. It'll get lower, but that's usually most often that is going to happen. So just with the example of earnings, stock has earnings. The implied volatility is usually a little bit higher in the near month options as the earnings are arriving. Once earnings are out, volatility comes in, as we say, or it collapses, it gets lower. The stock will still move, and there's that other component to it, but that's what makes trading earnings hard. So implied volatility, the effect on option prices. The change in the underlying stock historical volatility, it may or may not affect that option's price. However, other pricing factors remain constant, and the change in implied volatility will affect those option prices. So as implied volatility increases, both call and put option implied volatility increases. So that's something you should understand. If you're long options and implied volatility, you should understand if you're long options, you're long volatility. If you're short options, you're short volatility. So if you're long options and implied volatility goes up, your option value increases. Should, right? Doesn't necessarily mean you're making money, right? It all depends. That's all relative. Depends on how much you bought that option for. But that volatility component of your option will increase. If you're short options and option volatility goes up, you're going to be losing money on that volatility front, okay? So if you're short options, you want volatility to come in. These are one of the reasons why people are trading a condor, an iron condor. It's not like a straddle in that you have these upside calls that you're long and these downside puts that you're long. So that's kind of protection against a large move. But in general, that middle part of the condor is the part where you're collecting money on those options, and you want volatility to come in, and you want the stock to not move that much, and you want to just collect theta, as Ed was talking about, on those options. Changing implied volatility example. So let's say ahead of earnings, an investor buys the 105 call for 75 cents. So in that regard, they're bullish on earnings. Stock is at $100. We have 30 days to expiration. Okay? 3 weeks go by, and the shares remain flat. So the best thing about a lot of these examples, we try to keep some things constant for you, so you don't have to think too much about it. So the shares remain flat in that regard. And the 105 call price falls to 50 cents. What's happened?
Lost a quarter.
Lost a quarter. How do we lose a quarter?
Theta.
Time to trade decreased on the option, but also volatility decreased, right? And so that's one of the ways you'll see that happen. You'll see volatility come in, and not much else has changed. And this is one of those exercises we were talking about earlier. How do you, every day you should look back and say, why did I lose money on this particular option? Or why did I make money? Was it volatility came in? Was it delta? What are the reasons? And in this case, yeah, partially because of theta, but also because the volatility came in. So it's kind of a two-pronged thing in that way. Volatility Greek, it's option value sensitivity to volatility, okay? So when you have Vega and you're looking at Vega in your portfolio, that lets you know right away how much your specific option or your portfolio of options are sensitive to volatility changing. Now, that's where sort of sometimes a lot of people will look at, what's the overall market volatility and how is that changing overall? You can do that in a couple of different ways, and that's something that gets further down the line as far as your education. But a lot of times when people have a bunch of options, like Ed was saying, when you have a professional trader and they have a portfolio with a bunch of short options, they'll look at their volatility, they'll look at their Vega, their overall Vega, their portfolio, and they'll manage their positions based on that. How is overall market volatility doing? I'm selling, somebody could say they could have a portfolio of S&P 500 options. How am I expected to look at that portfolio? If they're short all those options in a lot of different S&P 500 names, they're going to wonder what's the S&P 500 volatility. And so that's what they are kind of looking at their measure. They're also looking at the individual stocks too. What's the volatility going on that? But if it's the same type of idea as if you're buying S&P 500 stocks and you're looking at the S&P 500 and saying that's kind of my measure, then you could also do the same thing with that volatility. So that's just kind of an example overall. So with a 1% change in the implied volatility, that's how you figure out your expected change in Vega. Similar to Theta, expressed in decimal form. A lot of these things are expressed in decimal form because you have those 100 multipliers on options. It represents the cash amount per option, and all other pricing factors constant. When you evaluate Vega, you're evaluating volatility. So calls and puts both have positive Vega. Implied volatility goes up, your Vega goes up. Implied volatility goes down, your Vega goes down. And again, that's just in generalized. It's also important to remember if you're long options, you're long volatility, meaning you're long Vega. If you're short options, you're short volatility, means you're short Vega. Let's look at Vega in action here. You have a pre-earnings. You have the stock price is 100. Oh, why am I using the computer? I can use this thing. I like doing things the hard way. So your Vega in action, you have pre-earnings. Stock price is 100. You have 13 days until expiration. And you have a 50 vol stock, or it's a 50% implied volatility, okay? So we have the 105 call. Value is $1.85. Delta is 30. Gamma is 5. Theta is 15. Like you said earlier, that means you're going to lose 15 cents a night on that particular option. Your Vega is 10, and your Rho is a penny. Post-earnings, stock is $5 higher, trading 105. We're closer to expiration, so 10 days has gone by. And your volatility came in 20%. So we have a 30 vol stock now. And even though the stock went higher and your call is at the money, a lot of things make sense here. And these are good ways to look at it. So your delta went up, right? Which you'd expect. Now your option is at the money. Your gamma went up because your option's at the money. Your theta went up because now it's at the money. And not only that, these things are closer to expiration. So gamma is higher at the money at expiration or closer to expiration. Same thing with theta. In this situation, your Vega is lower. One of the things you should always remember too about Vega is that Vega is not only is it measuring your volatility, but further out you have a lot more volatility on that option. Over time, it can change a lot more, right? So you can think about that variance in that way. Over time, if you have a longer term option, say you have a 6-month option, that's going to have more Vega to it. When you're closer to at the money and closer to expiration, your Vega is going to be little to none, especially if it's an at the money option. Those are the areas where you need to worry about your gamma because your stock, at this point, it's at the money. So whatever swing what that stock is going to do, whether it goes higher or lower, it's going to be largely affected by your at the money call is going to be largely affected, right? It's going to change a lot. So even with a 5-share increase in price, these calls lost value due to time decay and implied volatility. In this case, they both acted against you. If we just kept everything the same, say we said it was 13 days of expiration, and all of a sudden the volatility came in, you would still see a decrease in that option value. If stock didn't move, and there was a same expiration, and volatility just came in 20%, that would be the main driver of why your option lost value. So with a 100 strike call, is Vega greater or on a, is greater on a contract expiring 5 days, 30 days, or 90 days? Obviously the answer is there, it's 90 days. The reason why is because, like we just said, further out you have more volatility on that option as expiration is a lot further away. I'm not going to give you the answer on the first one this time. An investor puts an iron condor trade on. Remember, an iron condor trade is sort of a trade where it's a 4-leg trade, you're collecting theta, and it's sort of a neutral trade where you want to collect option premium. So an investor puts on an iron condor trade. Do they have a long or short Vega position, and will it increase in Vega help or hurt the trade? So will it help or hurt? Everybody? Come on, let's give me a little implied volatility in the room here. Everybody help or hurt? Where we at? Raise your hand for help. Hurt. Raise your hand. Oh, nobody wants to raise their hand in here. It's hurt, okay? So it's short. It's a short Vega trade, even though, just the idea that you're selling options, so it's short Vega, and it will hurt the trade if there's an increase in volatility or increase in Vega. If the stock drops 15%, and we're still talking about this iron condor trade, if the stock drops 15% as a result of unexpected company news, are long or short Vega positions likely to be positively impacted?
Long will be positively impacted.
The stock drops 15% as a result of unexpected company news, are long or short Vega positions likely to be positively impacted? Which ones are going to be positively impacted? Good job. Long Vega options are going to be positively impacted by a big stock drop move because the volatility is going to go up in that situation. It's going to increase. Back to Ed.
Thank you very much. The topic and the discussion on volatility is really interesting. And I will frequently get asked questions about volatility and earnings. And they'll say, Ed, can you just tell me about volatility and how it changes before and after earnings? It's going to be a little different for each stock. But what you'll often see, not always, but you'll often see that prior to earnings, you might have an increase or an uptick in implied volatility levels. And then after earnings, of course, you're likely to see that big drop. So a question might be, well, couldn't I avoid the uncertainty of the announcement and buy options 2 weeks before earnings and sell them 2 days and capitalize on what I expect to be that increase in implied volatility levels? And the answer is, again, it's just not that simple. If you remember what I said last time about the math behind the equations, prior to earnings and leading up to earnings, you might see bids hold for at-the-money and out-of-the-money options as some speculators come in, and option prices just don't simply decrease from one day to the next, as Theta is telling us they should. And if option prices are holding steady and days are passing, the only way the math works is to increase implied volatility levels. So buying those options and seeing an implied vol levels rise does not necessarily mean you're going to actually get higher option values as a result. And of course, after earnings, you're going to expect to see a crush or a decrease in volatility. The next question is, well, how long does it take for volatility levels to get back to where they should be? If I'm selling options, I might want to know that. And of course, that depends on the announcement itself. If there's a surprise earnings announcement, then it might take some time. As the stock moves around, you might have high volatility levels, and it might take weeks or months before the stock settles down and gets to its long-term implied volatility long-term average. If it's a non-event earnings announcement, then it might get down to its long-term average rather soon. Another question that comes up, you might hear economists or commentators say on TV or write articles and say, prior to earnings, the options market is expecting a certain percentage move in the stock price. Who knows where that comes from or how that calculation is made? Someone said straddles, and yes, the straddle is buying a call and a put at the same strike price or selling both. And that is where that computation comes from. If the stock's trading at $100 a share and the call and the put at the 100 strike are both combined trading for $5, then if you buy both, you need a 5% move in order to reach break even. Buyers of that straddle are looking for a larger than 5% move, and there's sellers who are expecting a smaller than 5% move. And that's where that calculation comes from that you might hear about the straddle. They look at it. And I'll keep in mind that calculation and that analysis is for a binary event. It's not usually used ongoing on a general or in a general basis. It's usually used for a binary event looking at the options that expire just after the event itself. I'm going to talk a little bit about Rho and then tie these things together as we wrap up the second session. Rho is an options sensitivity to interest rate changes. And you can see right away why Rho might be less important on a day-to-day basis. Look at the first one with a 1% change. Well, how often do you see a 1% change? And no one expects the next FOMC meeting to come out and announce a 1% change in interest rates. That just doesn't happen. But that is how it's expressed in decimal form. Again, a monetary value showcasing how much you would expect the option value to change with a 1% move in interest rates. So not only do interest rates not move very often, but they certainly don't move in 1% increments. Remember back on the trading floor days, I think we still had surprise interest rate moves back in the late 90s. I don't know when's the last time that's happened. So what is there, 8 FOMC meetings a year? There's about 8 times a year you might see interest rate changes, and they're largely predicted, known in advance. So rho is the amount you would expect to see the option value change. It is not likely that as an investor with a position, you would consider yourself having exposure or interest rate risk. Like all of the other Greeks, it assumes everything is constant. Now I'll describe the effect on calls and puts separately. Think about what you're doing when you buy a call option. It's a bullish trade trying to capitalize on the stock moving higher, but without buying shares. Your alternative is to buy shares of stock. You could pay $100 for shares of stock, or you can buy a call option for $1 or $2 or $3. You don't have to spend all of that money. Instead, you can keep that money that you didn't spend on the shares, put it in your account, and earn the risk-free rate between today and expiration day. That interest rate is considered, or that amount of money you earn on that capital is considered the cost of carry, or the amount you can earn at the risk-free rate. So if rates go higher for call options, would you expect the value of the call option to go up or down? The value would go up. It becomes more valuable to not spend money on shares of stock as interest rates go up. Keeping cash in your account becomes more valuable as interest rates go higher. So call values go up. Now what about puts? Think about what it is or what it means to own a put option. It's the right to sell shares of stock. So you would expect put options to have the opposite effect. So the prices of put options would go down as interest rates go up. So opposite for calls. For calls, you want more cash in your account. You can earn more cash, so the value of the call option is more valuable, so you can keep that cash in your account, and the put option is less valuable. So prices move in opposite direction. Where is it the largest? We've discussed this throughout the Greeks today. We said, delta's greatest for in the money, it's smallest out of the money, theta's greatest at the money and near term, Vega is greatest long term. What about rho? Well, it's really a monetary explanation for rho, in the money call and put options and long-term options. Those are going to be your most expensive options. And that's where the effect of interest rate changes are going to be most noticed. And there you see rates decrease, just the summation, rates decrease. That means call prices go down, put prices go up. And with rates increasing, calls go up, puts go down. Now this is, like I said, it's a very important piece of option pricing models to know what interest rates are. When interest rates are much more elevated than they are today, it becomes a more relevant discussion. But with low rates, as we're seeing today, and really no indication that rates are going higher anytime soon, rho sort of takes a back seat, but it really is an important, critical piece of the option pricing models. Now to put all this together and tie the Greeks in, the options price is a function of a number of different things. Delta and gamma are comparing stock price to strike price. And as you move on, considering the price of an options contract, you have intrinsic value and extrinsic value. Remember, intrinsic value is the in-the-money amount of the options contract. That piece, that component of the option premium is sensitive to stock price movements. The time value, or extrinsic value, all the value remaining above its intrinsic value, is subject to a number of different factors, and that's what we walked through today. The time till expiration, the days till expiration as they erode, has an effect on the option time value. Implied volatility Also, changes in implied volatility, changes in interest rates, possibly changes in dividends. Now, implied volatility, it's the great unknown. Nobody really knows where volatility levels should be. Going back again to the trading floor, what I was doing on the floor as a professional trader was reading theoretical values that I had coming from our pricing models. And of course, in order to do that, you need to use an implied volatility level to get theoretical values. And I was using that as my guide to make markets, to make bids and offers across the spectrum of all the options that I traded. I was changing that implied volatility level throughout the day. Now, as an investor, you may have an opinion on whether or not vol was high or low, but as a professional trading all the contracts, being on the long side and the short side, I let the market order flow tell me where to move implied vol. I never thought I was smarter than the market. So as orders were coming into the pit from brokers buying options, I was manually going in and ticking implied vol levels higher, raising my prices, and increasing the price at which I was willing to sell. And the opposite would happen when order flow was coming in on the sell side. It was a constant exercise all day long, moving implied volatility levels up and down until, I guess in theory, you're trying to reach a level where there's no trading. You're trying to reach that equilibrium level, which you really never reach. But you're moving and ticking your implied vol levels up and down. Changes to any one or more of these components affect the others. They are all dynamic, and they are all constantly changing. The Greeks help you predict, but they also help you understand. The classic example, going back to earnings, and Jamal put up the example. You buy a call option before earnings, the stock moves in your favor, and you lost money. And this is what can upset investors or confuse them. I spoke to an investor not long ago who was trading a stock in the low 30s before earnings, bought call options. Stock was up 5% after earnings, and said that he was down money on his call option. How in the world is this the case? And after verifying that this actually did occur, I said, all right, well, I don't know this name too well. Let's look into it. And I could see 52-week high was $49, 52-week low was $22. It's all over the place. After previous earnings reports, the stock had moved 12, 15, 18%. So this 5% move, which looks like a nice move in your favor, was actually a non-event. This investor just didn't quite understand how expensive the call option was when he bought it. This doesn't mean never to buy a call option, but understand, what are you paying? How expensive is this option, and what move do I need in order to be profitable? This investor didn't understand that and just thought, I think it's going to be a good announcement, stock's going to move up, and I'm just going to buy calls. Didn't pay attention to the price. It's really difficult to know what a call option is going to be worth after earnings, or what vol levels are going to be worth after earnings. One way you can do it is to use an options calculator. We've got one on our website, optionseducation.org. You can go to the tools and resource section. You can use an options calculator, which allows you the control to put in all of the inputs. You can say, here's the stock price today. Here is implied vol levels. And if you're trading an option, you can use current prices to determine what is the implied level that I just paid for this options contract. And then forecast it out. Change the days to expiration. Move them down by 5, 6, 7 days. And then estimate, well, what if volatility levels plummet to these different areas, from 50 to 30, from 50 to 20? What effect does that have on my options contract? And one of the advantages we had as a professional trader on the floor was having intimate knowledge of the securities that we traded. We had a pretty good idea where vol levels were going to be before earnings and where they were going to be after earnings. If you're tracking stocks and trading options on them, you will likely have that same level of familiarity after you go through a number of earnings cycles, watching that name, tracking implied vol. Where is it before? Where is it after? Then when you're ready to make a trade, you can go to the calculator. Say, all right, here's where it is today. I know everything about today's option. Now, what might it be if the stock goes up 5% next week after earnings, but vol levels move? Plug those numbers into the calculator, change the expiration date, calculate it out, and see what effect that might have on your options contract. Things to know to take away: Theta, the daily decrease It is a negative influence on the options price. I said when I walked through theta that theta and time decay are synonymous, but time value is not. Time value is different. Time value encompasses all of the other factors, which includes changes in implied volatility levels. These factors, or these Greeks, might be working in the same direction. If you have the passage of time and you have decreasing vol levels, they're working together. Sometimes they work in the opposite direction. It's not as simple as just tracking the stock price versus the strike price. So that's theta and vega related to delta and gamma. Buyers of options know a few things. Buyers of options want the movement in the direction they're expecting, whether it's calls and puts. And again, sticking with buying both. You're buying a straddle, you don't care where it goes, but you need movement. Which direction doesn't matter, but you have to have the stock move. That means you're trying to capitalize on delta, and you want gamma to also work in your favor. Remember what that was. Gamma is delta moving in a positive direction, positive correlation. Stock's moving up, my delta's getting greater, and as the stock keeps moving up, the delta's working for me. That's delta and gamma working for you. Buyers of options are trying to capitalize on movement while understanding that they're giving up time value, time decay with each passing day from one day to the next, and they know what their volatility exposure is. Implied vol moves higher work in their favor, and lower work against them. Sellers of options, again, considering selling strangles or selling iron condors, selling both sides of the market, looking for no movement. Your delta is relatively neutral. This is generalizing the universe of sellers, delta neutral. Short gamma, which means your movement and the changes in delta that accompany the movement are going to work against you, but you're paid up front to get that. You get cash up front, you're selling options. Your intention is to capture time value. When you sell options, that's what you're trying to do, capture time value. With that, theta is working in your favor, and you also understand that the short vega or implied vol moves higher work against you and lower work in your favor. Rho, really important to at least get a surface level of what Rho is. I talked about it's the change in interest rates, and I explained why that matters. If you buy a call option, you are not spending money on shares of stock. You keep that cash in your account. So if the risk-free rate that you can earn on that money increases, call options become more valuable. And the opposite with put options. Owning a put option becomes less valuable when the cash can earn more money at the risk-free rate. Altogether, investors can use these and track the different Greeks, but knowing that they're dynamic and they're going to change every day with every stock price movement, with every change in volatility, the other Greeks also change as well. So here's our website again, and if anyone has questions live, Jamal and myself will be available here after the presentation. There's our website, optionseducation.org. Everyone should please make note of the investor service team at options@theocc.com. You can ask them questions about what we offer and options themselves. We do webinars every single month. We're going to start January 15th. I will be giving a solo presentation. The manager of investor services, Mark Benzaquin, will be giving a solo presentation following me on January 22nd. Going to cover basics of options. Going to start there in January. We do these every single month. So go to the website and sign up for our webinar program and follow us on our social media channels as well. That's it for session 2. Going to take another 15-minute break. We'll be back at the bottom of the hour and wrap things up talking about options chains and symbology, maybe taking a little bit step back, giving your brain a breather. We've talked a lot about Greeks. We'll talk about a few more simple things in session 3 coming up in 15 minutes.